Preparing for accounting at American Electric Power, AEP, interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What makes utility accounting different from accounting for a typical industrial company? Utility accounting differs because regulated utilities often recover prudently incurred costs through approved customer rates rather than purely through market pricing. I would focus on long-lived transmission and generation assets, depreciation, fuel costs, regulatory assets and liabilities, and FERC reporting. Accounting must also reflect whether regulators expect future recovery or refund. That makes regulatory orders and rate cases especially important. In practice, financial reporting connects operational costs, approved rates, cash flows, and customer affordability. While answering, focus on regulation, rate recovery, capital-intensive assets, long asset lives, FERC requirements, cost-based pricing, and the importance of deferred regulatory balances in connecting accounting results with customer rates. Question 2. How would you account for a major transmission line construction project at AEP? I would first determine whether the project meets capitalization criteria and has appropriate approval. Qualifying direct costs, construction labor, materials, and allocated overhead would generally be recorded in construction work in progress. AFUDC may also be capitalized under applicable utility guidance. When the line is placed in service, I would transfer the balance into the appropriate plant accounts, begin depreciation, and assess rate-based treatment. Accurate project coding and cutoff are critical throughout construction. Make sure to cover capital project authorization, construction work in progress, direct and indirect costs, AFUDC, unitization, placed in service timing, depreciation commencement, and eventual inclusion in the regulated rate base. Question 3. What is AFUDC, and why is it important in utility accounting? AFUDC, or Allowance for Funds Used During Construction, represents the financing cost associated with qualifying utility construction before an asset enters service. It typically includes debt and equity components calculated under prescribed methods. Rather than expensing the amount immediately, the utility capitalizes it into construction work in progress, subject to applicable rules. Once the asset is placed in service, the balance is depreciated or recovered through rates. AFUDC therefore links financing, capital investment, and future customer recovery. In your answer, explain allowance for funds used during construction, debt and equity components, capitalization during construction, impact on plant cost and earnings, and the distinction between AFUDC and ordinary operating interest expense. Question 4. Explain rate base and why it matters to AEP's financial statements. Rate base is the balance of qualifying utility investment on which regulators generally allow a utility to earn a return. It commonly includes plant in service, certain working capital amounts, and approved adjustments, reduced by items such as accumulated depreciation or customer contributions. Rate-based treatment matters because it determines whether invested capital can generate regulated revenue and an authorized return. At AEP, large transmission and distribution investments make accurate classification, depreciation, and regulatory support especially important. Be sure to mention utility plant, approved working capital and other qualifying items, accumulated depreciation, regulatory approval, allowed return, and how rate-based treatment influences recovery, earnings, and investment decisions. Question 5. How would you distinguish a regulatory asset from a regulatory liability? A regulatory asset generally represents a cost already incurred that regulators expect the utility to recover from customers in future rates. A regulatory liability usually represents amounts collected or recognized before the related cost, or amounts expected to be refunded to customers. Examples include deferred storm costs, pension differences, fuel under recoveries, and over collections. I would confirm that future recovery or refund is probable, document the regulatory order, and amortize the balance consistently with the approved rate mechanism. Focus on the direction of future recovery or refund, probable regulatory treatment, matching of costs and revenues, examples such as storm costs or fuel over recovery, and the need for documented evidence. Question 6. How are fuel and purchased power costs typically accounted for at a regulated electric utility? Fuel and purchased power costs are generally recognized as operating expenses when incurred, but regulated utilities may recover them through fuel clauses or other approved mechanisms. If actual costs exceed amounts collected, the difference may become a regulatory asset. If collections exceed costs, it may become a regulatory liability. I would reconcile actual volumes, prices, and customer billings, investigate variances, and verify approved amortization. This process helps separate temporary recovery timing from permanent operating performance. In your answer, discuss operating expense recognition, fuel adjustment mechanisms, under and over recovery, regulatory assets or liabilities, forecasting, reconciliation, and the effect of volatile commodity prices on reported results. Question 7. When should depreciation begin for a utility plant asset? Depreciation should generally begin when the asset is substantially complete and available for its intended use, not simply when final invoices arrive or when a rate case is approved. I would verify the placed in service date, transfer the asset from construction work in progress to the correct plant account, and apply the approved useful life and method. If components become operational at different times, component level tracking may be needed. Proper cutoff prevents overstated construction balances and delayed depreciation. Make sure to cover the placed in service date, readiness and availability for intended use, construction completion, asset retirement considerations, rate approval versus accounting recognition, and proper monthly cutoff. Question 8. How would you analyze an impairment indicator for a coal or gas generation asset? I would first identify triggering events, such as sustained market price declines, environmental regulation, reduced dispatch, physical damage, or a planned retirement. Then I would test the asset under the applicable accounting model using supportable cash flow forecasts, market assumptions, and regulatory recovery evidence. I would compare carrying value with recoverable value or fair value as required. If an impairment exists, I would record it promptly and separately assess whether retirement obligations or regulatory recovery create additional accounting consequences. Discuss triggering events, recoverability or fair value analysis, forecast cash flows, regulatory support, market changes, useful life assumptions, abandonment decisions, and the distinction between impairment and normal depreciation. Question 9. What is the accounting treatment for an asset retirement obligation at a utility? An asset retirement obligation is recognized when a legal or contractual obligation requires future removal, closure, or remediation and the liability can be reasonably estimated. I would initially measure the obligation at fair value, generally using discounted expected cash flows, record the liability, and capitalize a corresponding amount into the related asset. The liability is subsequently accreted, while the capitalized amount is depreciated. Revisions to timing, cost, or discount assumptions require careful remeasurement and documentation. In your answer, explain legal or contractual retirement duties, initial fair value measurement, present value discounting, asset capitalization, accretion expense, liability updates, and examples involving plants, ash ponds, or nuclear facilities. Question 10. How would you account for a storm restoration event that creates significant costs? I would first capture storm-related labor, materials, contractor invoices, and emergency response costs in dedicated work orders. Normal repairs would generally be expensed, while replacements that extend useful life or improve capacity may be capitalized. I would separately evaluate insurance recoveries and any regulatory order permitting deferral. A regulatory asset should not be recorded solely because management expects recovery. The evidence must support probable approval. Strong documentation and consistent cutoff are essential because storms can create large, unusual variances. Be sure to mention immediate cost capture, damage assessment, capitalization versus expense, insurance proceeds, regulatory recovery, restoration work orders, documentation, and avoiding premature recognition of uncertain future recovery. Question 11. What revenue recognition issues can arise for an electric utility? The main issue is recognizing revenue for electricity delivered even when customers have not yet been billed at period end. I would estimate unbilled revenue using meter readings, usage patterns, weather, rates, and subsequent billings, then reverse or true up the estimate. I would also review fixed charges, demand charges, connection fees, and alternative revenue mechanisms under the applicable guidance. Accurate meter-to-ledger reconciliations and cutoff controls help prevent material overstatement or understatement. Focus on electricity delivered, customer billing cycles, unbilled revenue, estimated usage, rate structures, contracts, connection charges, alternative revenue programs, and the need to reconcile meter data with the general ledger. Question 12. How would you explain the difference between FERC accounting and generally accepted accounting principles reporting? FERC accounting provides an industry-specific uniform system of accounts and reporting structure for electric utilities, supporting regulatory oversight and comparability. Generally accepted accounting principles governs AEP's external financial statements and may require presentation or recognition adjustments beyond the FERC books. I would maintain a controlled mapping between detailed FERC accounts and the general ledger, then identify consolidation, disclosure, and generally accepted accounting principles adjustments. Understanding both frameworks is important because operational accounting, rate cases, regulatory filings, and investor reporting rely on related but not identical information. Make sure to cover FERC's industry-specific uniform system of accounts, regulatory reporting, generally accepted accounting principles financial statements, account mapping, regulatory treatments, consolidation adjustments, and why both frameworks matter to AEP. Question 13. Walk me through a monthly close process for a regulated utility. I would begin by closing subledgers and validating operational feeds, including customer billing, plant, payroll, fuel, and purchased power. Next, I would record accruals, depreciation, AFUDC, regulatory amortization, unbilled revenue, and other standard entries. I would reconcile bank, subledger, regulatory, and balance sheet accounts, then perform analytical review against budget and prior periods. Finally, I would investigate unusual movements, obtain evidence for judgmental balances, complete review controls, and deliver accurate reporting on schedule. In your answer, cover subledger close, accruals, plant additions, depreciation, fuel and purchased power, regulatory balances, revenue estimates, reconciliations, variance analysis, review controls, and reporting deadlines. Question 14. What journal entries would you expect for a plant asset moving from construction to service? During construction, qualifying costs accumulate in construction work in progress, with a FUDC recorded when applicable. Once the project is ready for intended use, I would debit the appropriate plant in service account and credit construction work in progress for the supported final balance. I would then begin monthly depreciation using the approved useful life and method. If costs are not eligible for capitalization, I would expense them instead. The transfer should be supported by completion certificates, asset records, and management approval. Discuss construction work in progress, accumulated construction costs, AFUDC, transfer to the appropriate plant account, depreciation commencement, and the importance of supporting documentation and approval of the placed in service date. Question 15. How would you investigate a large unfavorable variance in transmission and distribution expense? I would first quantify the variance and determine whether it is concentrated in labor, materials, contractors, outage activity, or other categories. Then I would compare actual volumes and rates with budget, review weather and outage events, test accruals and cutoff, and check whether costs were incorrectly capitalized or expensed. I would speak with operations and procurement to validate the business explanation. Finally, I would document the root cause, assess whether forecasts need updating, and escalate material issues. Be sure to mention materiality, timing, volume and rate drivers, accrual accuracy, weather, outages, maintenance activity, capitalization policy, budget assumptions, root cause analysis, and communication of corrective actions. Question 16. What internal controls are especially important in utility accounting? Important controls include approval of capital projects, segregation between initiating and recording transactions, review of manual journals, and reconciliation of subledgers to the general ledger. I would also emphasize meter-to-bill interface controls, placed in service approvals, regulatory asset roll forwards, access management, and review of estimates such as unbilled revenue. Evidence should demonstrate who performed and reviewed each control. Effective controls reduce financial reporting risk while supporting reliable FERC filings, generally accepted accounting principles reporting, and regulatory rate case data. Focus on authorization, segregation of duties, asset additions, meter-to-bill interfaces, journal entries, regulatory balances, access controls, reconciliations, estimates, evidence retention, and testing under internal control requirements. Question 17. How do deferred income taxes arise in a regulated utility? Deferred taxes arise when book recognition differs from tax recognition, often because tax depreciation is accelerated relative to book depreciation or because repair deductions occur at different times. A utility must also consider normalization rules and regulatory treatment of excess deferred income taxes, which may require returning benefits to customers over time. I would reconcile tax fixed asset records to book balances, assess deferred tax roll forwards and valuation allowances, and confirm that regulatory balances reflect approved recovery or refund mechanisms. In your answer, explain book tax timing differences, accelerated tax depreciation, regulatory treatment of excess deferred taxes, normalization, valuation allowances, rate effects, and reconciliation between tax records and financial statements. Question 18. How would you evaluate a proposed capital project from an accounting perspective? I would evaluate whether the project creates or enhances a long-lived asset, whether costs meet capitalization criteria, and whether the investment is authorized and likely to receive regulatory recovery. I would review the expected in-service date, useful life, AFUDC eligibility, environmental obligations, and potential impairment risk. The project should have clear work order coding, budget controls, and supporting approvals. From an accounting perspective, disciplined classification at the start makes future depreciation, rate-based support, and audit evidence much stronger. Discuss business purpose, capitalization eligibility, rate-based prospects, project authorization, expected useful life, AFUDC, environmental obligations, impairment risk, budget controls, and the information needed for future depreciation and regulatory recovery. Question 19. AEP discovers that a prior period regulatory balance was misstated. What would you do? I would quantify the error by period, determine whether it is a correction of an error or a change in estimate, and assess materiality under generally accepted accounting principles and regulatory requirements. I would review the underlying order, recalculate the balance, and consult technical accounting and auditors on the appropriate correction and disclosure. I would also evaluate whether customer recovery or refund assumptions change. Finally, I would identify the control failure, implement remediation, and document the full decision process. Make sure to cover materiality, error versus estimate change, correction methodology, regulatory implications, disclosure, control assessment, root cause, audit coordination, and whether customer rates or future amortization must be adjusted. Question 20. Why do you want to work in accounting at AEP, and how would you add value? I am interested in AEP because utility accounting combines technical accounting with infrastructure that directly affects customers and regional economic activity. The scale of transmission, distribution, and generation creates meaningful challenges around capital projects, regulation, estimates, and long-term asset stewardship. I would add value through disciplined reconciliations, clear variance analysis, strong documentation, and willingness to understand the operational drivers behind the numbers. I also recognize that accuracy and ethics matter because accounting results influence regulators, investors, employees, and customers. In your answer, connect interest in essential infrastructure, regulated accounting complexity, AEP's transmission and generation footprint, analytical discipline, reliability, teamwork, ethical judgment, and a specific way your skills support accurate reporting. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.